The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is Esther Gulius, the tax lady, and we're here to talk taxes and to answer your questions. So get those fingers ready to dial in 8030930, 8030930, star 930 on a cell phone. You can text us at 3930, and I drug Chris out this week. Hey, Chris.
Hello, Esther.
That's Christopher Fabian. Hey, Chris. It's good to be out, right?
Yes, it is.
It's good to be out. So this is the weekend before the deadline for corporations.
Correct.
Right?
Monday is it.
Actually, tomorrow is the 15th, so
Right.
they extend it to Monday. So if you have a corporation or an S corporation, that
Partnership.
or partnership, that's all due on Monday, and EG Tax can help you. And I know probably a lot of people think, oh, well, with the COVID thing, we don't have to do it, but you do. They haven't changed any of the extensions so far, and we're just doing tax returns per normal,
Yeah,
right?
we're still busy people,
Yep.
and it's great. But, and the thing is, what's the important about Monday? If you file your return on Tuesday, Wednesday, it's $195 per partner or per shareholder that the return is late. So if you have 3 people, you're looking at a $600 penalty
Right.
for 1 day.
Right. So you want to make sure that you get those corporations and partnerships, and the March the 15th is the deadline because that's a Sunday. They extend it to Monday, and EG Tax can help you. We have 32 area offices to help you. We're open tonight till 5, the rest of the week 9 to 9, and we can do it. And if you are somebody who's what is it called?
Quarantined.
Self-quarantine. That's it. You can send your stuff through our website, and we can take care of it for you if that's the case.
We can do
I will tell you,
virtual,
I
so
feel
we-
like I'm kind of living in the novel Chicken Little. Do you remember that story?
Yes.
Where the sky is falling, the sky is falling. And, I'm taking all of this seriously. I used to lick my finger to turn the pages. I'm not licking my finger anymore. I'm wearing those little things that look like condoms on my
finger
fingers.
condoms.
Finger condoms. And so I'm taking everything seriously. I'm wiping down the desk and everything.
Washing your hands.
And washing my
more
hands.
often
And that, we're hitting people elbow to elbow when we're doing all that. But I have to tell you, I just think what's going on. Some people are so afraid. And, I had a doctor, I was doing his tax return the other day, and I said to him, well, Doc, what do you think? I'm thinking I'm really going to get the scoop, right? He said, well, Esther, like 50,000 people die every year from the flu. So, I don't get it. Why they don't make a big deal out of the normal flu? Why are they doing it out of this flu? So I don't know. But anyway, we are here to help you. 8030930, 8030930, star 930 on a cell phone. And of course, what's happened in the market is like,
And that's all part of this. It's it's the fear. The media has installed fear.
all
in the
right, we're
public.
not going to make you afraid, but we're going to spend 2 hours telling you how bad everything is. And so, oh wait, we have somebody that just died. Okay, somebody just died. I mean,
Oh wait, didn't they die yesterday? Somebody else died yesterday from something else.
something.
And
Well, I'm telling you.
A lot of people know we're believers.
Yep.
We're Christian, and
Right.
it says, "Be not afraid."
I'm not
Don't
afraid.
live in fear.
Not afraid.
You
Not
got to be
afraid.
cautious.
Right.
But don't.
I'm not
live in
going to go
fear.
run out in front of the car. I'm not going to go say to somebody, please cough on me. But I'm doing everything I can do, but I'm not afraid.
Right.
Anyway.
But
All
let's
right,
talk
but we're going to
taxes.
talk about, do you want to talk about taxes? We're talking about, since the extension deadline, the deadline for corporations is going to be Monday, we thought we'd talk about businesses. And so a lot of people don't even realize that they would do a business return because when they get a 1099 miscellaneous non-employee compensation, they don't know what that is, and they put it on the wrong line.
Yep. They'll put on line 21 instead of a Schedule C. And
Right.
Then 18 months later, you'll get a nasty bill in the mail.
It was interesting because just this afternoon, a client of mine came in and his son is in college and got a 1099 miscellaneous non-employee compensation. So I said to him, now, did your son have any expenses to produce this income? He said, no, I just, we're just put it down because I don't want, he says he doesn't have a business. I said, this says he has a business. So if I don't, I'm going to do a Schedule C anyway. So did he have any expenses? Yeah, I think he probably did. Well, if we put the expenses on, then it reduces his net profit, which reduces his FICA, which reduces his tax liability. And because he got a 1099 MISC, non-employee compensation, that's what you got to do.
Yep. And it probably saved him $500 to $1,000 by.
Right. Well, I don't think it was quite that much, but it saved him about $150. $150 is a lot of money.
Especially
to me.
a college student.
Absolutely. So I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. We can talk about businesses or anything that's on your mind. If you want to give me your 2 cents, you think I'm crazy about how I feel about the coronavirus. I mean, I had a lady the other day that came in wrapped in cellophane. She was wrapped in cellophane, and then she kept saying to me, it's coming. And it was very distracting because she was all wrapped in cellophane, but, it's so sad. You can't get within 1,000 miles of Wegmans. But anyway, all right, so small business, basically you can choose the kind of business that you want. You can start off with a sole proprietorship.
Right.
And without any kind of protection, just a small business. But a really wise thing to do if you're a small business is to do a limited liability company.
An LLC
right?
or an S Corp,
right?
Depending on what you're doing and and how much protection. I mean, an LLC and an S Corp basically have the same umbrella of protection, But you got to look out because I tell all my clients it's a sue happy society. I hate to say that, but you blink. You look at somebody wrong, and they're going to sue you.
Yep, that's right. And so if you spend the money, because you have to register with the state, register with New York State. If you have a sole proprietorship, let's say Mom and Dad's ice cream store, and you've just been operating it just as Mom and Dad's ice cream store, but you never had any protection. So if somebody passed out in front of your store eating your ice cream, and they say, "Oh, it was your fault," and they sue you, your whole estate could be sued. But if you have a limited liability company, pretty much the only thing that they could sue is the assets, provided you acted in a business
correct
way.
Everything was up.
Right. If you'd had poison in your ice cream, I think that
and you knew about it and you didn't do anything.
Right. That's right. So there's sole proprietorships, and then a sole proprietor can make an election to become an S corporation or a C corporation. All corporations start off as a C corp. But most small businesses and many people that are C Corp should make an election to be an S Corp. Now, why is that, Chris?
The taxation. Because the C Corp pays its
double
own tax at 20%.
21.
Oh, 21%, sorry. And so we just had somebody yesterday, their net profit was $5,000, and we're trying to explain to them, you should become an S Corp, and they didn't want to hear it. So they spent $1,000 on taxes.
Instead of $50.
Instead of $50.
Right.
So hey, but if you want to, that's why we're here. We're trying to help you save money.
And we want to make it so it's simple so you understand why. See, if you're set up as a C corporation right now, which means that you're taxed on the net profit and the distribution, so it's double taxation, number one. Number two, all C corps are taxed at a flat rate of 21%.
Right.
And what Chris is saying is it should have been at 10% or even less. Because if it would have flowed over, he might have paid no taxes.
Right.
So, and you don't have the double taxation. So those kind of things are really important. And you really, if you're doing your own return or if you haven't had anybody counsel you, give EG Tax a call because we really want to help you. And those clients of mine that are listening know how important it is to make sure that you deduct your health insurance
Yep.
outside, right? You
Yep.
want to make sure you deduct your health insurance
As the
as
adjustment
opposed
to
to Schedule A. You put it as an adjustment.
Yep.
And maybe you should hire your spouse and put them on an employee business
health
reimbursement plan so that everything goes through the company. I mean, there's so many things that can be done, but again, you need a level of expertise, right?
Right.
Okay, we're going to take a short break. I'm Esther Gullius, the tax lady. I know we got Salvador and Larry calling in and other calls, 8030930, 8030930, star 930 on your cell phone. We're going to take a short break. We'll be back right on the other side. I got all my sisters with me. Hey, I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone, and you can text us at 3930, and we're kind of talking about businesses because business corporation deadline is extended till Monday, and EG Tax will help you, but I have Salvador who's been waiting. Hey, Salvador, how are you?
Oh, yeah, I'm doing good. I was calling about my son. You know, he's slow and he's on Social Security disability.
Uh-huh.
And he works for, like a sheltered workshop.
Okay.
He's like, they put him on piecework. And you know what he makes? Maybe, I say about every 2 weeks, he makes about close to $80.
Okay.
Is he still, but they keep no tax.
They take no tax out of him?
No, they said he's tax exempt.
Okay, so he if they haven't taken out any income tax, federal or state, then he doesn't have to file. He has no other source of income.
Oh, no. Is he entitled to earned income?
Oh no, he's not necessarily entitled to earned income credit. Let me ask you this: does he live in your home?
Yes.
All right. Are you giving him over 50% support?
Yeah.
No or yes?
Yes.
Yes. Do you work?
No, I'm retired.
You're retired. Okay. You didn't retire on a disability, did you, Salvatore?
No, I'm 82.
Oh, okay. All right. So your son then is between the ages of 25 and 65?
Yeah, he's 57.
Okay, then he would be entitled to an earned income credit. Yes.
Oh, that's good to know.
Okay.
Can I have one more question?
Sure.
Yeah, I was going to open up a special needs trust for him.
Okay.
They said I got it through the lawyer.
Mm-hmm. That's a good thing.
He gave him an EIN number.
Mm-hmm.
What is that?
That's, well, you know, everybody has a social security number, right?
Yeah.
When you set up another entity, like a corporation or a partnership or a trust, then that's the ID number, like a social security number, that identifies that vehicle.
Yeah. Okay. And then will he have to file income tax?
The trust may, depending on how much income is produced.
Right.
Yeah. Well, I don't think it's that much because it's been going down with the stock market. I guess they put.
Oh, well, let's hope, Salvador. I think it's going to come back.
Oh.
Okay?
Okay.
All right. Thank you. Thanks for calling.
Yeah. Bye.
Thank you, sir. Bye-bye. And just like Salvador's son didn't have to file a return because he had no withholding, because he was between the ages of 25 and 65 and his income is lower income, he's going to get an earned income credit even though he has no children.
Right.
And so he wants to file.
Correct.
Right?
Yep.
I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 3930 regarding the 1099 MISC. Must those receiving a 1099 MISC file by Monday? No. The 1099 miscellaneous income goes on your personal return. We're strictly just talking about corporations and partnerships.
Yep, you have to look at the tax ID number of the recipient. If it's your social, then no. If it's a 2-digit - 7-digit number, depending if you're a corporation or a more than a if you're more than two or more owner of an LLC, then yes.
Right. Well, that was a good point, Chris. That's right. So Chris brings up a good point. If it came under the EIN number, then it's another entity that would have to file then by the 15th, possibly. So take a look. Chris is right. You want to take a look at the who is the recipient, whether it's under a Social Security number or an EIN number. Thank you. That was a good catch.
You're
like
welcome.
that. Let's talk to Larry. Hey, Larry.
Ashley, darling, it's Larry.
I know. How y'all doing?
My darling, I'm doing so good. I mean, say I missed you terribly, but I'm thinking about you guys all the time.
Thank you. What's new?
Well, Ashley, first I need to ask you, the lady wrapped, I'm laughing, the lady wrapped in saran wrap.
She was like 82, Larry.
Bless her heart.
Do you want her phone number?
Chris, I love you.
But Larry, this was saran wrap on top of her clothes. I mean, it was really interesting. But anyway, yes, Larry, how can we help you?
Well, darling, I just want to touch base with you and Chris, saying that I'll be sending my 1099s to you shortly, and in fact, this week, God willing. So we can get that done. What else? And I think that's about it for now.
All right, Larry, we look forward to talking to you.
Take care. Bye-bye.
Thank you. Bye-bye. That's Larry from Georgia. Larry
He's
from
really
Georgia.
from New York City.
He's not from New York City.
Yes, he is.
Larry, is Larry
Yes,
really?
he is.
And how did he get
was born
that?
in New York City.
Well, he didn't spend much time there,
No.
that's for sure. Okay, let's go back to the phones and we'll talk to Mike. Hi, Mike.
Hi, Esther. How are you?
Good. What can we do for you?
Every year in November, I change my dependents on my W-2 because I get stupid overtime and I'm going to get a refund.
Okay.
I'd rather have the money in my paycheck.
Yep.
In January this year, I went to go change it back to normal 5. Won't let me do it online.
Right, that's true. It's really complicated now.
So what do? I am stuck at 15 right now.
Because they figure out your withholdings. There's a line that says extra withholding, and you're going to have to plug in a figure that you want to make sure you have taken out of your check.
Because the way they have this new computation on the W-4, basically they want to get you to flat even. If you answer all of that accurately, you end up being at flat even and you won't get a refund.
Okay, which would be great, but when I look at it, though, I still have the 14 or the 15, whatever I plugged in last November. Can I?
You mean allowances?
Yes.
Oh, okay. Well, certainly you should talk to your you have to go on. You have to do it online. Is that what you're saying?
Yes.
Through your employer.
Yes.
Yeah, so the new W-4 is, are you single, married, and you would check that. Then it says, how many children do you have under age 17? How many people are in your house over 16? And then it will figure out the withholdings where you should be to, like Esther said, break out even. But if you want to make sure you have a refund...
Lie
then
about your kids.
You could lie about your kids, or you could say, I want an extra $150 coming out of my
Because
paycheck.
really, the W-4 is nothing but a tool to help the employer figure out the proper withholding, okay? And the way this new W-4 is done, it makes people crazy, So the thing is, it's just a tool. So it's not like somebody's going to come and arrest you if you have 4 kids and you put 2 down. But if you put all 4 down, they're going to take less out.
Okay.
You follow us?
Yep, I know what you're talking
All right. Thanks, Mike.
The under 17 is $2,000.
Right.
Yep.
Over 17, it's $500. 17 or older, it's $500.
Yes. All right, thanks, bye-bye.
All right. Thank you.
We're talking about deadlines with corporations. I want to make sure everybody also, sales tax is due on the 20th.
Oh, very good
a
point,
week
too.
from yesterday. A week from yesterday, your sales tax is due. They'll penalize you $50 if you're a day late.
Right. So you want to make sure you get that done. And again, EG Tax will help you. We have an entire accounting department as well. So again, talking about businesses, so you have a sole proprietorship, which you can make an election by, and we use biz filings. Or you can use another one?
You can go right to the Department of State. There's
Yep.
LegalZoom.
Right, and so you can make an election to become an LLC, which will protect, which basically puts a layer of protection on. You can also make an election to become a corporation, and that way the corporate net profit then flows over to the shareholder's tax return, and it's only taxed once if it's an S corp or a partnership if you have a number of partners that are in the business. And again, those are all due, except for the sole proprietorship. Those are all due on Monday the 16th.
Correct.
Right?
Yep.
Okay. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. And I'm going to go to Karen in Orchard Park, who's been waiting. Hey, Karen.
Hi, Esther. How are you?
Good.
Good. I have a question about the publication 526 dealing with charitable deductions.
Okay.
And they're telling me when I go to the online that the 2018 form and instructions are being revised because there was a law enacted December 20th.
That's where you can take 60% of your adjusted gross income maximum as a itemized deduction. So that's one of the things that was changed with the charitable.
And they're also saying with the RMDs going right to charities, which RMDs changed to age 72.
Right.
You can still do it at age 70 and a half.
Right.
Mm-hmm. But they don't have anything online for us to refer to. Like, how do you know that it's 60%? Did you get some kind of notification from the IRS?
Well, I mean, I study. I mean, I get all kinds of stuff because that's what I do for a living, right? But people that that don't do this for a living, you have to do your research, just like I do before tax season. You would do while you're doing your tax return. Are you somebody that would give 60% of your income away to charity? Well, I think we lost her. Anyway, I'm Esther Gullius, the tax lady. We're going to take a short break for the news. We'll see you on the other side. Hey, to us, you are family. I'm Esther Gullius, the tax lady, with Chris Fabian from EG Tax, and we're here talking about taxes, talking about businesses, talking about your particular situation. You can join us in the conversation, 8030930, 8030930, star 930 on a cell phone, or you can text us at 3930, and we do have a text, Mr. Chris. What do we got?
It says, if I put my income-producing real estate into a trust, is there a separate tax form I must file?
Yes. Right?
Yep.
Because when people don't realize that when they're setting up these different entities, these entities all have to file their own returns. So if you set up a corporation, the corporation the IRS looks at it like a person. Sort of. So that entity has to file its own return. A trust has to file its own return. Now, everything has minimum filing requirements, but these entities all have their own ID numbers and all their own rules, and yes, you have to file a separate return.
And if you put it in a trust, you better make sure the rent is payable to the trust, not to you. The trust pays its own utility bills.
Which really is true about anything. Right. I mean, like, for instance, if you have a corporation and people are writing checks to you and you're putting it in your personal bank account instead of in the corporation, that's wrong.
Right.
I mean, it's right.
Yep.
So some of that's the hardest thing, I think, for people when they start these corporations or trusts is to understand that this is considered a separate entity.
Yep, and that's a good way. You were talking about how the insurance, the liability protection of being an LLC or doing a trust or corporation. That's one way that the seal will be broken is by doing improper bookkeeping.
Right, and you got to make sure that you have a separate bank account. The money's all going to the separate thing because in the eyes of the IRS in the state of New York, that is a separate entity.
Correct.
Right?
Yes.
I'm Esther Gullius, the tax lady, 8030930, 8030930, star 930 on a cell phone. You can text us at 3930, and I got Paul here. Hi, Paul.
Oh, good afternoon.
Hey, good afternoon.
Yeah. So last Saturday, I thought that I heard you say something about somebody called in asking about pension, and but anyways, let me start off from square one.
Okay.
Both, I'm drawing on two pensions. One of them I started up December of 2019, so I'll have a little bit of income from that. These are, both pensions have asked me, well, one of them to fill out a W-4. The other one just had like their own kind of form. So both of them are fully taxable, federal tax.
Right.
But I thought I heard last Saturday that you had said something about a pension is not taxable up to a certain amount or something.
That's right. If it's a non-federal, state, or municipal pension,
Yeah.
then the first $20,000 you receive, if you're at age 59 and a half or over when you're receiving the pension, is tax-free on the state of New York. It's a subtraction. If you're receiving a federal, state, or municipal pension, regardless of your age and regardless of when you received it, it's fully tax-free, fully on the state.
Okay. So first 20,000 is tax-free in the state, for the state.
For the state. So all the income is going to flow over from the federal. Then then on page 2 of the IT 201, there's an addition part where you have to do some additions like a 414H, and there's a subtraction portion, and that's where you would put your federal, state, and municipal pensions or your regular pension exclusion if you're over the age of 59 and a half in a non-federal, state, or municipal pension.
Yep. Okay. I guess you call these non-government pensions.
Okay. Or IRAs, by the way.
Private. Yeah. Well, these are privately funded employers. Yeah.
Okay?
Yeah. Okay. Wonderful.
Okay, Paul. Thanks for calling.
Yep. Talk to you.
Bye-bye. So, okay. So, and that's correct. Your pension on the state of New York, you have to, if you haven't subtracted it, amend the last 3 years' returns. If you're over the age of 59 and a half and you've been receiving Social Security's annuities fully, their first $20,000 is tax-free.
Right.
Right?
Yep.
Okay. Wanted to talk about the daycare business, too.
Okay.
And I know there's a lot of people that are paying independent daycare people. Now, we don't usually see the independent daycare person because if we were, we'd make them report the income. But a lot of people that we have, they've paid an independent daycare person, and what do they say, Chris?
Oh, I don't send them anything because they don't report
They don't report it. So I thought I'd talk about daycares because if you're somebody that's paying a daycare provider, and I know that it's very important to have your child cared for in a loving, wonderful way. And so you don't really want to mess up the relationship with yourself and Sally. But the truth is, if Sally were educated, there's a very good possibility that she not only wouldn't pay much in taxes, but she might get an earned income credit. So the truth is, many times Sally is shooting herself in the foot because there are a lot of expenses that a daycare provider can take to reduce their income. So let's say mom and dad gave Sally $6,000. Or maybe you as somebody are paying your parents to watch the kids and the parents aren't reporting it and you can't get the credit then because there's a daycare credit that the parents can get for paying the daycare, which they don't do because they don't want to mess up the daycare thing. So some of the things that you can deduct would be like toys and books and travel.
And wipes, diapers, wipes.
Right, but there are no wipes anymore. And there's no toilet paper anymore. But anyway, and the other thing is you can reduce the profit by the use of your entire home.
Yep.
So, because let's face it, you can't keep a kid in a room. So so that means that the IRS has a special way to reduce the taxability if you're a daycare provider, if the kids come to your home. And it's basically the number of days that you use your home for daycare multiplied by the number of hours used. And then it sets up a very large percentage. And then you can take off your property taxes, your mortgage interest, your utilities, your repairs, your insurance, anything that would be part of that house, and you'd be surprised how much of an expense comes down. So it's a win-win. Sally, who's the daycare provider, is reporting her return properly. The people paying Sally get to take the credit, and it's a win-win.
Right. And some people, it doesn't impact a lot of people, but it could. Some people may not have enough quarters in for social.
Oh, Chris, that's very good. I love that.
So even if they report $1,000 worth of income as a net profit, they're going to pay Social Security tax. That counts as 4 quarters in to Social Security.
Right, and you need 40 quarters, which is 10 years.
So if you're 12 quarters short, there's 3 years worth of daycare.
Start babysitting.
And now you can get Social Security.
Right, and that's
and
again,
Medicare.
those are things that you need to think about because it's interesting. I had a client the other day, and she never had the 40 quarters because she was a minister, quite frankly, and she didn't have the 40 quarters. And I said, "How many quarters are you short of collecting Social Security?" Because she had opted out, and she said, "I maybe 3 or 4 quarters." And I said, start a part-time job, start a small business,
Do you want to be a receptionist?
Yeah, that's right. That's right. So getting back to the daycare business. So if you're paying a daycare provider and they're not claiming it, I will tell you, you can say to them, I have to report my wages. You have to report your wages.
Yeah.
It's only right. Sometimes I've had self-employed people, contractors, for instance, that might have 2 or 3 children, and they say, I've had the wife come in and say, "No, my husband won't file jointly with me because I want him to report his under-the-table income." And I'll say, if he comes in and we do his return right, you'd be surprised what'll happen. And the bottom line is, I can think of this one guy in particular. I turned him around. We started off, we took all of his expenses. Because he had 3 kids, he ended up with this humongous earned income credit, and it paid his FICA. And so now he's really, he's got all of his contractor stuff, and he's doing really good. And his kids now are older, and he's got a real viable business, which is so great.
Yep.
All right, I'm Esther Gulius, the tax lady from EG Tax, 8030930. 8030930, star 930 on a cell phone, and you can text us at 3930. Now, another thing is, what if your employer is not paying you on a W-2?
Well, if it's legit and you are subcontracted out, then it's a 1099. But if they're just saying, you know what, I want to avoid paying into Social Security and get the unemployment insurance and the workman's comp, so I'm just going to give you your $400 right as a regular check, and then that's up to you to pay your own taxes. Then you could turn around and fight them by doing an SS-8, and there is another form, and I can't think of what that is off the top of my head, and say to the IRS, I don't think I'm self-employed. I think I'm an employee. And so then they could make a determination. So then you end up only paying the 7.65% of your Social Security instead of the 15.3%.
Right. And plus, if you're a self-employed person, if you're accepting this 1099 from this person hiring you and you don't fight it, you don't get unemployment.
Yep.
If you get injured on the job, you can't get workers' comp.
Yep.
So here's some of the things that the IRS and the state of New York looks at. It's called facts and circumstances. The manner in which the taxpayer carries on the activity. In other words, if you're working for somebody and they say, "Here, Esther, you sit up at the front desk and you're the receptionist. I'm paying you $10 an hour," and they don't take out any taxes. They write you a check. Well, the manner that your business is conducted, I'm conducting business like I'm an employee, right? Second thing is the expertise of the taxpayer or the advisors. The third thing is time and effort spent by the taxpayer in carrying out the activity. The expectation that assets used may appreciate in value. This is facts and circumstances for hobby. But the bottom line is, if you are somebody and they tell you when to come, when to go, how much they're paying you, they're providing you with the assets to work. You can't switch off and have Lucy take your place. They're expecting you to be there. You're not self-employed. You're an employee.
Right.
Yep. And what Chris said is absolutely correct. You should turn them in.
Yep. But I like my job and I don't want to lose it.
Well, here's the thing then. What you need to do is have a kind of come to Jesus meeting with your employer and say, because many times it's just ignorance on the employer's part. They might say, "I don't know how to do payroll."
Right. Yep.
And there's only like 1 million payroll companies.
And, and the thing is, too, if you're one of these people who pay people this, And New York State the Department of Labor comes in. Holy cow, what a can of worms you just opened up for yourself.
That's absolutely correct. But you do have power. I would suggest, if that's your situation, go and talk to your employer first, the person that's giving you the 1099, and suggest that they switch. I had one lady one time that was getting, now minimum wage at that point in time is maybe $9 an hour, around there, and she was getting $4.50. And I said, you can't get $4.50. You get minimum wage. And she said, but he won't pay me minimum wage. I said, you have options. You can go to New York State Department of Labor and talk to them. Oh. So she went back and talked to him, and so then he raised her to $7 an hour, and she was happy. Oh, well.
Oh, my
anyway,
gosh.
Let's go back to the phones. 8030930, 8030930, star 930 on the cell phone, and we're talking to Dan. Hi, Dan.
Hey, how are you, Esther?
Good.
Hey, I'm a first-time caller.
Thank you.
I have a question for you.
Yeah.
I was employed as a CEO of a company in last year, in 2019. And I was let go as the CEO. I didn't receive any severance pay or any kind of package. And it kind of came as a surprise to me when I was released. So I had to tap into my IRAs. So I took money out of IRAs to really, pay my expenses, my mortgage payment, my car payments, and that, so we can maintain, a similar lifestyle as when I was working. I did pay taxes on it. I didn't pay any penalties at the time. So my question is there anything I should be looking at doing as I file my taxes this year, for last year, obviously, taking in consideration that it was a hardship. I didn't really have a choice. I didn't have any other money in any other places that I could have paid these bills with.
Okay, well, first of all, when you were under the age of 59 and a half, obviously, right?
Correct.
Okay.
Under age 55?
Under 55, correct.
Yeah. So there's exceptions to penalty, one of them being that you were totally and permanently disabled, which is not your case, that you were under the age of 55 and severed employment, that you're under the age of 59 and a half, that it was an IRA and you used it for a first-time home, that you used it to pay medical bills that exceeded the 7.5%, that you used it to pay a federal obligation.
Used it to pay for higher education.
Right. So this is not your situation. So it looks like there's not an exception to penalty, so you're going to get stuck with that 10% penalty on the federal. What you might want to look at is, did you subsequently get another job, Dan?
Yeah, I was out of work for about 90 days. So,
Okay, so you got another job.
correct.
All right, so did this new job provide you with a pension plan?
They do not.
So what would be an option is you might want to think about putting money into an IRA and taking some of that money off the table that you're going to be stuck paying taxes on if you have that. Are you a married guy?
I am.
And you're under the age of 50?
I'm 52.
Okay, so you and your wife could put, if she doesn't have a pension plan, you could put $14,000 away, and that would take that money off the table. It's still the money on the left hand is still fully taxable, subject to a 10% penalty. But on the right hand side, if you were able to put $14,000 away into an IRA, that would eliminate $14,000 in taxation, $14,000 in taxable income.
Okay, great.
Okay.
Great. Well, I appreciate the advice. Thank you.
All right. Thanks, Dan. Bye-bye. Yeah, that's tough. If you're ever in that situation where, just like what Dan went through, where it's a catastrophe, many times what people will do is take the whole thing out at once, that, like, let's say $80,000. They take the whole thing out, subject to penalty and subject to income taxes, federal and state. But let's say 4 months later, like, he got a job, he maybe didn't need that whole, I don't know what he took out, it was, let's say $80,000. If you would have just taken out a little bit at a time as he needed it, he wouldn't maybe be suffering so much on his tax return now. Okay, we got another.
We do. My son is a senior in college in Ohio and earned income only in Ohio in 2019. No New York income. We were planning to claim him as a dependent on our joint account. How does he file his state tax return?
Tell him.
So he would have to file a Ohio return and a New York return.
Right.
So, and then New York will give him a credit for the tax he paid to Ohio. So he'll still probably end up paying New York some money, but it won't be on all of it. It will be, don't forget to take the credit for the tax he paid to Ohio.
Right.
And he make sure you do the box that he can be claimed as a dependent.
Right. So you're going to claim him as a dependent. He's going to do an Ohio non-resident tax return. Any taxes that he has to pay in Ohio, for instance, if he ends up with maybe a $20 liability on Ohio, then you can do a 112R on the state of New York and get a credit for the taxes he paid to Ohio on his New York State return because he's a resident of New York State.
Right. I would say call us and we can go over it more in detail with you at the office.
Right. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. And text us at 3930. Okay, let's see. What else do I want to talk about? Business versus hobbies. So a lot of time, I had a client not too long ago who came in and was giving me, I started this business and I don't have any money that I made on it, and here's all my expenses. And then you say, are you trying to make a profit? I don't care. I really like what I'm doing. Okay, well, the IRS is not going to allow you to take a loss on a hobby if you don't have a profit motive, right?
Right.
So you just, many times people just keep writing off expenses year after year after year. You're only allowed to take a loss 2 out of 5 years.
Right.
Right?
Yep.
And then they can...
they can convert it to a hobby themselves.
Right.
The IRS, that is.
All right. The other thing is, we just like Dan said when he called, I bet you if I do 30 tax returns in a day, I bet you 5 or 6 of them all make a contribution to an IRA, because an IRA is an absolute great way to qualify. Traditional IRA is a great way to come up with a deduction that you didn't know you had coming. Because you can put up till April the 15th, you can put up to $7,000, your wages up to $7,000 in a traditional IRA, and it saves you money. And they just changed the law that people over the age of 70 and a half, starting in 2020, if they're still working, can contribute to an IRA.
Right. So not for 2019, but only 2020 going forward.
Right.
So we got another text. It says, what are the requirements to claim a loss on rental property? I'm hearing I can't claim it unless I make under $150,000 and after 3 years.
Okay, well, the $150,000 is right.
Yep.
Not after 3 years. So if you have rental property, and many times even a rental property that has a break even, you're not losing any, not making any money, when you take the depreciation, it ends up losing money. It's a paper loss. So that would then reduce other income. But if your income exceeds $150,000, actually, if your income exceeds $100,000, as you start moving to $150,000, you start to lose $1 for every $2 you make over $100,000, and so then those losses are suspended, like suspenders.
Maybe, and now I'm going to get really complicated, and people are going to go, "What?" Unless they're a real estate professional. Not a real estate agent, someone who buys and sells, lists homes. A real estate professional is someone who rents houses for a living, their own rental houses. So if they spend more than 700 hours doing it, documented hours, they can claim the loss. So if their income's over $150,000. Right. So if the husband's a doctor and makes $300,000 and the wife's job is to manage all the rental properties, they would be able to claim the losses. Right. So you got to look, but the average person, 150, it's all gone, it's suspended. Right. 3 years again, that's not a thing. And if it were your wife that were doing the property management, she'd want to make sure she has great documentation and that she can prove it in the event of an audit that she was the real estate professional. Yep. Okay. I'm Esther Golias, the tax lady, and Chris Fabian from EG Tax. We're going to say goodbye for another week. We hope that during the week, if you need the best tax help, remember you can send in your returns if you're in quarantine through our website. But all of our offices are open, and we're doing returns, and we pray you are staying away from the coronavirus. So talk to you next week. I'm Esther Golias. Bye-bye.